Okay, welcome back, everybody. Thanks for registering for the second session and coming back in again. We wanted to do a slightly different format this time out and take some of the additional data we produce in the annual national accounts that we have the luxury of producing once a year. We can't do this quarterly. And we wanted to draw out some of the information from that. So in particular to focus on the domestic economy. So we're going to start off with Justin Flannery is going to talk to us about the consumption data. It's a lot more detailed on an annual basis, and he's going to cover some of the revisions to that series. Then Maria O'Neill is going to talk to us about the investment data. Again, a lot more detail on that with by assets and by NACE sectors. And then Conor Prescott is going to talk to us about the wages data that we have a lot of in our quarterly, but even still there's a lot more detail in the annual results with increased NACE breakdowns and the distributional work. So I'll hand you over to Justin first to talk on consumption.
Thanks very much, Chris. So good afternoon all. So as Chris says, there's going to be two parts to my presentation. I'm going to highlight some of the additional detail we have in our annual release that's not available in our quarterly. And I'm also going to add a little bit more detail on some of the revisions in today's release. So first of all, what is personal consumption expenditure? So it's what we all spend on goods and services, and it's a component of the expenditure approach to estimating GDP. So we have various different sources for compiling the consumption estimates. We've business surveys like the Annual Services Inquiry. We have household surveys like the Household Budget Survey. We've trade data, we've census data, we've administrative data, and we've direct inquiries to companies. So this graph is showing domestic household consumption at a two-digit COICOP level. So COICOP stands for Classification of Individual Consumption by Purpose. It's a particular standard for classifying expenditure developed by the UN in 1999. So you can see some of the categories here at a two-digit COICOP level. There are categories like miscellaneous goods and services, transport, health, education. So each of these two-digit codes can be further broken down into three-digit codes and even more detail, but the greatest detail we publish at is 3 digits. I should just add here that the COICOP standards were revised in 2018, so we haven't yet moved to the new standards, but EU member states will be required to start transmitting under the new standards starting from later this year. So as I said, we publish at a 3-digit COICOP level. So if I reproduce this graph at a 3-digit COICOP level, it would look like this. There's a lot of detail there on the y-axis label. I don't expect you to be able to read it all, but the point is there's quite a bit of detail even at just the 3-digit COICOP level. And so, for example, we saw at a 2-digit level that miscellaneous goods and services had the largest growth rate in 2023. Miscellaneous isn't very informative, so what's contributing to that? So in this graph, I've highlighted in green all the different 3-digit COICOP codes that feed into miscellaneous goods and services. So we can see that insurance has the largest growth rate, but personal effects not elsewhere contained and financial services not elsewhere contained also have significant growth rates. And miscellaneous is quite a broad category, so there's a good few other items in there as well. We could do the same thing for transport, which had the second highest growth rate. So at a 3-digit COICOP level, transport services had the largest growth rate. Purchases of vehicles also had a significant growth rate, and then operation of personal transport equipment is more middle of the road in this distribution of growth rates. So all this additional detail is available in 10.1 of our release. That's the current price to this table. And then there's an equivalent chain link table, I think it'd be 10.3. So we have a lot of different aggregates in this table, so I thought I might talk through them. So the first row there, households expenditure on goods and services in Ireland. This is the sum of the 12 two-digit COICOP codes that we saw earlier, and it represents all the expenditure that happens in Ireland. So whether that's by residents or, for example, tourists visiting here. Ultimately, we're interested in producing the accounts on a resident basis. So we have two adjustments to make. We have to add in the expenditure outside the state. So this is Irish residents holidaying abroad. And similarly, we have to subtract the expenditure by non-residents. So that gets us to total expenditure of households, the national concept. This is the resident basis. To get to personal consumption expenditure, the component in the expenditure approach to GDP, we need two further items. We need the expenditure of NPIsh, or non-profit institutions serving households. So ultimately, the expenditure of the NPIsh is consumed by households, so that we include that. And also we've had in the general government expenditure on goods and services provided to households. So you can break general government expenditure into individual and collective expenditure. So the individual expenditure is where it makes sense to associate it with a particular individual, and collective, that makes less sense. You can further break down the individual expenditure into market and non-market. And so it's the market expenditure that gets captured as part of PCE. So just to sum that up, personal consumption expenditure is total expenditure of households, national concept, plus the expenditure of NPIsh, plus the social transfers in kind via market producers. Just one other aggregate I'll just highlight here, that's actual individual consumption, because it's especially important in international comparisons. And the only difference with PCE is that we include all of the individual expenditure of government, so the market and the non-market. So let's change gears a little bit and look at some of the revisions to PCE. So as was mentioned in the press conference, this is a benchmark revision year, and we have significant revisions going back a number of years. So the top panel there is looking at the growth rates for today's release and also last year's vintage. So it's not clear from the top graph, because the scale on the y-axis is quite large because of the pandemic volatility. But on the bottom, you can more clearly see the changes. So we're plotting the differences to the growth rates. So for example, with the exception of 2016, where we revised down the PCE growth rate by 0.5 percentage point, we're otherwise revising up, ranging from 0.3 percentage points in 2019 to 1.3 percentage points in 2022. And so as Kieran alluded to in the press conference, this is largely due to our new census and household budget survey data. So if you just start with the census, that's our primary data source for rent. And so we're plotting levels in the top panel here for actual rentals for housing and imputed rentals for housing. So the imputed is the kind of theoretical rents that homeowners would pay if they were renting their own property. So you might be surprised to see that we're actually revising down the rents in this release, and that's clear to see on the bottom panel, where we're again just plotting the differences. So for the actual rentals for housing, we've downward revisions of up to 400 million in 2021 and 1.4 billion for the imputed rentals in 2021. So how does this fit in with the story of upward revisions to PCE growth? Well, at the same time, we've incorporated the new census data. We've changed how we're deflating the data. So we've switched from using residential tenancies board data to using the consumer price index for rent. And that was partly for conceptual reasons, partly because the census was suggesting the CPI was more appropriate. So the net impact of that was that we revised down our deflators for rent, which you can see along the bottom panel, and we increased volume, with the exception of 2022, but we've increased volume. And I suppose the change in the growth rates isn't massive, but rent has a large weight, so it's having an important contribution to the revision to the PCE growth rate. The other revisions I wanted to highlight were the HBS, or Household Budget Survey related revisions. So the HBS is a large survey of households, which to now we've carried out every few years, but this one was delayed a couple of years by the pandemic. So this is the first release incorporating the new HBS data. Some of the areas where we've had significant revisions because of the HBS I have here. So the first one there is food. I would say this isn't a standard revision insofar as most of our food estimates are based on production and trade data, but the HBS was suggesting we were understating food consumption, so we've revised up our estimates there. We've also had relatively large revisions to audiovisual, photographic and information processing equipment. So this is reflecting changes in consumption patterns since our last household budget survey. And finally there, we've also had significant revisions to package holidays. So hopefully you have a better understanding of some of the revisions in PCE, and you're curious to explore some of the additional detail we have in our release. So I think we're going to have questions after each presentation. So if there's any questions, I'll take those now. Thank you.
Thanks, Justin. That's great. So that's a sample of, quite really detailed data that, as I said, is a luxury we only get to do once a year. And we thought it was useful to bring that up and explain it to you. Again, we have a very silent chat online from 50 plus people, but John is going to do us the honour of kicking us off in-house.
You don't show the savings rate. The savings rate in Ireland, it went up dramatically during the pandemic, came down, but it seemed to remain high in the latest data that I've seen now. Are you revising that? And it's different. It remains above where it was in 2018-19, whereas for other European countries, it's come back. So my first question is, do you have anything on the savings rate? Secondly, on the deflation of the imputed rent, I was at a Bureau of Economic Analysis in the US, online seminar on how they do it. And they felt that they were using the rents which were advertised are from a particular data set, but they were the marginal rents for people who were renting new. But it wasn't capturing the average rent that people pay, because people in accommodation over a long period, the rent will be lower than the marginal rent. So are you capturing the average rent, or is it the marginal rent for new renters, which might exaggerate the rent? And the third thing was the upward revisions in the food. I was wondering, all right, I see it goes back before Ukraine, but the HBS covers households. But there would been a lot of people in institutional settings who were personal consumers, where their consumption of food might have been lower, or what they bought, because they were in institutional settings, where you have a substantial increase in numbers of people in institutional settings. Could that be, so you're adjusting for the HBS, but could you be over-adjusting there?
Yeah, so I was starting off with the household savings rate. I haven't shown overall revisions to the current price figures here, but I think they're fairly modest. But I do think in the later years, I think on net we have increased it. So that might further help with the savings rate. Like I know at last year's reliefs, we had significant upward revisions to the current prices, and that helped bring down the savings rate. So it has come down somewhat. I'm not quite sure with the new data where it would be, let's say, pre-pandemic. On the rent, yeah, so I mentioned we switched to the CPI partly for conceptual reasons, and it was exactly as you described. So with the Residential Tenancies Board, we were just capturing the marginal rents, and at least conceptually the CPI is supposed to be capturing the kind of stock, and it's I suppose it's more plausible that it is, insofar as the CPI for rent is lower than the RTB. And again, with the census data, if we were trending forward with the CPI, we would have arrived at a figure much closer to the census, kind of suggesting, I suppose the census data was suggesting that the CPI was more appropriate. On food, and whether we could be overstating the adjustment, I'm not too sure. I do know when it comes to food, we were curious to see the household budget survey data, because I know in the kind of PPP data and international comparisons, our food consumption levels were very low. So I'd be surprised if we were overstating it now. But I suppose we could look at the PPP data when that's updated for this release, and see where we are in kind of international comparisons. That might give a sense there.
Follow up. I'm not sure on the HBS, but I know on one of the data sets, it may be Silk or the HBS, that households include children who are not actually resident, but who might be in university accommodation. And it's their consumption would not be captured, because the way you capture the HBS is it's the bills on the household. But if the households include non-resident children in institutional setting who are there not captured as a separate household, would that affect the results?
Possibly, but I suppose, again, we did feel even before getting the HBS data that our food estimates were probably low. So when the HBS was suggesting upward revisions, that we felt that was certainly going to be closer to the truth than our previous set of estimates.
We've a couple of questions that are coming in online, so I'll try and bring these up for you. So we have two questions in the centre. Well, Thomas Conor wants to ask one. So can we unmute Thomas so he can... Thomas, you should be able to ask your question if you'd like.
Thanks very much. Can you hear me now?
Yeah, absolutely. Go ahead.
Okay, great, thanks. Two quick ones, please. One on stocks. There's a very large increase in stocks in 2023. It looks like the highest annual figure for a long time, and it puts a big gap between final and total NPV. So one's 2.6, the other's 5.3. Could you just explain a little bit what's driving that big increase in stocks? I know the stocks figure includes non-resident stocks, so in particular, whether they're domestically located stocks or foreign stocks. And then just secondly, on the consumption revision for 2023, it is very large versus the initial estimate we had, so it's from 3 to almost 5. And that changes our understanding of the growth in the domestic economy last year substantially. So the background from Justin is very helpful on some of their sources or causes of the revisions. But in terms of the quarterly numbers for this year, we obviously always interpret those with caution, but I mean, how much confidence can we have in the quarterly numbers this year? So some of the factors that you've corrected for the 2023 number, does that mean that they're carried through into the quarterly estimates this year so that we can put more weight on them, or do we continue to have to put significant caveats over the quarterly numbers for this year in anticipation of possible future revisions? Thanks.
Thanks, Thomas. I'll answer the stocks question quickly and then leave you with the consumption one, I guess. Any of the large changes you get like that in stocks are foreign held stocks. So the volatility that we see in changes in stocks are usually stocks owned by Irish firms but held abroad. So maybe I can come back to you on that one later on if we need to. Let Justin answer the consumption question if you want to now. There's two more just to let you know in case you...
Yeah, the comparison with the sum of the quarters. So I suppose it's kind of difficult to compare our annual and quarterly process, but I think one of the key factors in the upward revision to the growth rate was around the foreign travel data, and so BOP revisions there that have fed through. But yeah, I might have to come back to you on that one.
And Tara in Central Bank's asking us when HPS is going to be published. I should know that, but do you remember? It's very soon, isn't it?
Well, I think Kieran suggested it might be next month.
Yeah. So Tara, I think we're a couple of weeks away. They certainly have that ready to go, the HBS. We're all eagerly awaiting that, and we're hoping to see the HBS on a kind of a rolling period from now on. So instead of every 5 years, we might be able to at least produce or pull off annual data, and that'll help Justin an awful lot around the consumption estimates and with the distributional work that we're hoping to update as well. Conor in the SRI has a question, but he asked it just before you answered John's question, but he's asking why did we move between the CPI rents and RTB rents census? I know you spent a long time looking at that. I'm not sure if you... Conor, do you want to come on and ask the question just in case Justin's already answered it? It's Conor O'Toole, if we can...
Yeah, sure.
Hey, Conor. Yeah, go ahead.
Yeah, thanks a million. Actually, you did partially answer my question. Thanks a million for that. In that you were trying to get more at the average rents rather than the marginal new tenancy rents, which I think makes a lot of sense. I think that's a good revision. One thing maybe just to consider going forward would be whether you can include some of the new RTB data where they have existing tenancy rents that's come online from 2022 onwards. So might be worth thinking about in the future whether those data could be incorporated, because rather than a survey-based estimate, that would give you the population of existing tenancy rents and give you a much better guide for what's happening on the ground going forward. Just also, while I have everybody, just to say thanks a million for these seminars. This is really great to get this insight and to be able to have this discussion. So really appreciate the team for doing this. Thanks again.
Thanks, Conor.
Yeah, just to comment on that. So yeah, the RTB are now publishing rent data based on the stock, but obviously they haven't produced a back series for that, so it's no use to us for revising the back series. But certainly going forward, we'll keep an eye on that and how it tracks with the CPI, and in discussion with Price's colleagues. That might be a conversation we'll have to have in the future about whether we switch to the newer RTB measure of rents. But thanks.
Thank you very much, Justin, for that. That was quite a bit more than you expected, I think, on that one. So that's great. And I'll hand over to Marie now to talk us through the investment numbers. So, and the mic over to you.
Hi, so good afternoon, everyone. So I'm going to look at another aspect of the expenditure approach to the national accounts today. So specifically investment or capital formation, with a focus on the domestic element of this. So I wanted to start by looking at two of the figures that we publish in the domestic demand chapter within the A&A publication. So this chapter is one that we added 2 years ago in A&A 2021. And then last year we revised it again to include modified domestic demand. So we added 4 new tables at that point. So figure 9.1 there on the left shows the components of final domestic demand. So that's namely PCE, government expenditure, and gross fixed capital formation. Figure 9.2 then we published for the first time last year. So it also shows PCE and government expenditure, but it also shows modified gross fixed capital formation. So this excludes investment in aircraft leasing, and it excludes R&D service imports as well as trade in intellectual property. So looking at the two figures side by side, I suppose the first point to note here is the proportion of capital formation in each of the graphs. So in 2023, capital formation accounts for over 37% of final domestic demand. In 2019 and 2020, that figure was well over 50% each year. When we take out the globalised elements and look at the modified domestic demand figures, the modified gross fixed capital formation accounts for just under 21% of modified domestic demand in 2023. And then when you go back to 2019 and 2020, we're talking about maybe 22, 23%. The second thing just to draw your attention to is the variability in capital formation. So by its nature with capital formation, we're often dealing with a small number of some very large transactions. So this becomes more apparent when you just look at capital formation versus the modified version side by side. So firstly, just to point out the difference in scales on the axis. But what figure 9.2 shows is that when the globalised elements are taken out, the domestic element of capital formation, it's much less volatile, it's a much smoother series. And so it gives a better picture of what's happening in the domestic economy. So I want to take you through some of the tables that we have now in the investment chapter. So table 11.3 here looks at capital formation broken down by asset type. So this particular table is in constant prices, but we do also have the same breakdown in current prices in 11.1. And the data in this table will come from a range of sources, both from within the CSO as well as external and administrative data. So within the CSO, we get a lot of information from the structural business surveys. So the ASI, or the Annual Services Inquiry, as well as the CIP, which is the Census of Industrial Production, as well as the annual Prodcom survey. We'd get exports and imports of capital goods from our trade division. The new dwellings completions would feed into our dwellings estimate here. And then the balance of payments figures would feed into items like aircraft leasing. Externally then, we'd use a lot of direct inquiry data as well as administrative data. So for example, the fourth item there, transfer costs, would include stamp duty figures from revenue. So the level of detail that we produce in this table, it's slightly different to what we produce in the quarterly national accounts. So I just want to bring you through it item by item. So the first item we have here is dwellings. So in the Q&A, we have both a dwelling series and an improvement series. Here we combine them to give an overall figure. But just to point out, I suppose, if you do need that breakdown, it's available through the Q&A. We break out roads then for the annual table, which we don't do for the quarterly. So this would be new construction or significant improvement on roads as opposed to just the ongoing repair and maintenance work. We then have the rest of building and construction, which fell this year. So as Kieran would have highlighted in the presentation earlier, we are working on improving our building and construction figures. So the first phase of that took place this year with some improved sources. Transfer costs then is the last item in that first four. It makes up the final element related to building and construction. So transfer costs are the costs involved in transferring ownership of an asset. So as I mentioned, stamp duty will be one of them, but things like land registry fees or other legal fees would also be included here. So the next four items then are what we have in the quarterly as simply machinery and equipment. So transport equipment makes up the bulk of this. So this is where we account for aircraft leasing, but transport equipment would also include other aircraft, motor vehicles for business purposes, as well as other transport equipment. So by its nature, this is one of the items that's highly influenced by these global elements. So on an annual basis, we are able to break out aircraft leasing and publish it in the quarterly national accounts. We do try to do this on a quarterly basis. It's not always possible. The next category, agricultural machinery, I suppose it pretty much speaks for itself. It's a small enough series, relatively stable. Other machinery and equipment, which is next, so amongst other elements, would incorporate computer hardware, telecommunications equipment, as well as industrial machinery. And then the final item there is cultivated biological resources. So it's a small enough item, and that would be things like orchards or livestock for breeding. The last four items then in the table make up what we class together as intangibles in the quarterly accounts. So here we're able to break them down into software, exploration, artistic originals, and finally research and development. So research and development makes up the bulk of this and would be the most volatile element of capital formation. When we're looking at the domestic economy, both software and research development are heavily influenced by the globalised factors. So when we take out our R&D service imports and our trade and IP, both of these categories are impacted. And again, an annual breakdown is available in the Q&A. Then the final element I want to highlight in this table is just the additional breakdown of changes in stocks. So that then brings us from our fixed capital formation figures to our gross physical capital formation. So this next chart then just shows the percentage change in capital formation in constant prices from 22 to 23. So we can see the four asset categories at the top recorded a percentage increase. So that would be dwellings, research and development, transport equipment and roads. So despite the majority of categories showing a decrease, overall capital formation increased by 2.8% in constant prices from 22 to 23. And that would be to do with the relative size of each category. The next slide, I suppose, highlights that. So these are just two views of the same figure that appeared in the investment chapter. And you can see on the left there that R&D is by far the largest contributor to capital formation. It made up just over 45% in constant prices in 2023. When R&D is hidden, it just becomes easier then to see the remaining elements and their relative contribution. So transport equipment there in the lime green is the next largest category. And as discussed, aircraft leasing would make up the bulk of this. Then we have dwellings, other building and construction, and other machinery and equipment. And then the last category of note then is software. So moving on then, table 11.4 is the other presentation that appears in the investment chapter of the annual publication. So this is where we show capital formation at an ACE A21 level. And this breakdown has been part of the publication since the 2020 accounts. So the two largest sectors we can see are Sector C, manufacturing, and Sector J, information and communication, with manufacturing in 2023 over twice that of the next highest sector. So as we highlight in the text of the investment chapter, both of these sectors would be dominated by assets that relate to research and development, so would be the most globalised. Research and development related assets also make up a high proportion of Sector M, which is professional, scientific and technical activities. However, we do tend to consider this a more domestically focused sector. Aircraft leasing then is accounted for in Sector N, which is administrative and support services activities. And then the largest domestic sector you can see is Sector L, which is real estate activities. And that's where we account for dwellings. So the next slide then just shows the 2023 sectoral breakdown of constant prices. So it just visually highlights the contribution each sector makes. So I suppose what stands out there is the manufacturing, which by itself accounted for about 33% of capital formation last year. So I just wanted to finish then by highlighting an upcoming publication, the estimates of the capital stock of fixed assets for 2023, which will be out later in the year. So last year, it was published in early November. We're probably looking at a similar timeline this year. So this is capital stock as opposed to capital formation. So while we're dealing with the same asset categories, the same sectoral breakdown, but where capital formation looks at what's added across the year, capital stock looks at what's held in the economy in total. The tables that we publish here align with the NACE A21 breakdown that we show in tables 11.2 and 11.4. But we have additional tables in this publication that break down the asset types by sector of use. So it's a useful way of seeing where the assets are concentrated in the various sectors. The capital stock publication then also contains estimates of the consumption of fixed capital or depreciation. And these are what are used in all of the net figures in the ANA. So the figures for ANA will be available, or for ANA 2023 will be available then when this comes out. So I'll leave it there for today. I just want to thank you all for your time and your attention. Hope you found it of use, and yeah, I'm happy to take questions now.
Thanks, Marie. So I don't know while people are just thinking of questions on that one to come in. Did I answer the stocks question? I should have let you answer that.
Yes.
I answered that okay? You didn't want to add anything to that? They're usually any of the volatility. Thomas is great. Any of the volatility we get in stocks is usually around foreign held stocks. Niall has his hand up. Is that Niall Conroy? We could probably unmute Niall if you can.
Yeah, great. Can you hear me now?
Yeah.
Perfect. Yeah, great. Thanks. This is very interesting and great to see the work that's being done on this. I was just looking to pick up actually on the professional services investment because that looks really strong in 2023. Obviously fell to almost nothing in 2020. So I was wondering if you could give a little bit of colour of what the main items there is. It software? Is it physical buildings, things like that? Or what sort of breakdown you have on that?
I don't have the breakdown in front of me, but I think as I highlighted that sector that is influenced by research and development, so that would have played a factor in it. But no, I can come back to you with a further breakdown then.
We can go back on the slides if that helps. So everybody else sees what Niall's asking about.
Yeah, sorry. Yeah, it did. It was quite high there in 2023.
That's a good point. Now we'll definitely come back to you on that one.
Great, thanks.
Question in the room for John?
Just on that table, would it be possible to show it based on modified investment as well? Or would that pose confidentiality problems? Because it would be useful, because one of the things that Ireland, when you take a modified investment as a share of net national income, is very low by developed economy standards, and understanding the sectors where this is happening would be important. Are we similar in one sector or another? So if you could break down that'd be useful. Just one other general request, and you mentioned this, that you provide more breakdown on some items in the quarterly accounts than in the annual accounts. And I find it frustrating that I've got to go, because the quarterly are consistent with the annual, and I've got to go and add up the quarterly. So anything that's in the quarterly should be presented in some table somewhere in the annual. Now, obviously, you can't do it in the other way because there are a whole range of things that are only available on an annual basis, but it would be helpful. Now, I could do it for myself, but it would just make life easier for people. If it's only for me, then don't do it. But if there are other people who would find it useful, then I think it would be worthwhile doing.
Yeah, no, I mean, certainly on your second point, it is a conversation we had in here a couple of days ago. Absolutely anything we produce for the quarterly, we should look at, including for the annual as well. Obviously, we're too late to do that this year, but it is something we will look at going forward. In terms of producing the modified investment table, I suppose that's something I'd have to run through and see what impact it would have on confidentiality before a decision could be made on whether that could be produced or not. But certainly, no, it's a good suggestion.
It gets me really thinking about this, right? So it's a really good question. That if we strip out the IP from the manufacturing sector, what's left? And it's really useful information on physical investment in Ireland by the firemen in particular. And likewise, but you look at the admin and support service where the aircraft is, and you're left with domestic aircraft. And we should test that. And similarly with the asset classes, to bring in the improvements there from the quarterly. Any other breakdowns we can reliably get in there? That's something we talked about, trying to improve that a bit, because it's all domestic stuff we're trying to highlight, I guess. Two useful items coming in the chat. Our colleague from Business Statistics is telling us that the HBS is due out this day week, for anybody eagerly waiting that one. And Killy Carroll's just asked for, it's Conor Toole came in first and said the modified investment by sector really would be great. So that's secondly kind of John's point. And then Killian's asked, is there a further breakdown on the other building and construction coming? Maybe that's just a strategic one you do want to answer, do you?
Yeah, so building and construction, I mean, we've done a fair bit of work on improving our building and construction estimates this year. We've added some industry sources, improved our direct inquiry sources. It is, I suppose, the first phase of a longer term project that we're doing to try and improve our building and construction estimates. And one element, I suppose, of that project will be to see what else we can actually publish separately and what else we can break down and publish in the building and construction figures.
Okay, that was really good. Might grab that back again. So I guess we'll keep moving on. So to finish out, Conor Prescott's going to talk to us about wages, the wages data that's come out. There's a lot more detail on that, and I guess on profits too, there's a lot more detail, but you're going to focus mainly on wages today in the chapter on wages and profits in the ANA. So over to you, Conor.
Yeah, thank you, everybody. So this final part of the seminar, I'm going to talk about compensation of employees. So within the income approach, we have compensation of employees, which is wages, and then we've profits. So they're the two sources of income. And because compensation of employees is entirely domestic, it's worth kind of just highlighting a couple of the additional tables that we've added to the publication, the annual publication and quarterly, in the last couple of years that just go into a little more detail. This is acting a bit funny. There you go. Thanks. Yeah. Okay, so I'll talk about three items that we've added to the publication in recent years. But first, if you look over to the pie chart on the right, you'll see that, and this is something that Kieran showed earlier, compensation of employees is now about a third of gross value added, mostly driven by the decline in profits from some of the foreign-dominated sectors, but also because COE has been rising each year. So it is a significant part of value added in the economy. So the three items I'm going to talk about firstly are COE by subcomponent. So this is looking at wages and employer social contributions. I'll then look at COE at constant prices. So this is something we added last year. I'll just explain what that is, what it's trying to achieve, and show a couple of tables. And then finally, we'll look at the COE income distribution as well. So firstly, COE it's the total cost of labour. So it's primarily wages and salaries, so basic wages, overtime, holiday pay. But from the employer's perspective, they also have to pay social contributions. So mainly employers' PRSI and pension contributions, and various non-pension contributions as well. So in the context of labour costs, total labour costs, it's important to look at not just wages and salaries, but also social contributions. So we provide this breakdown in the annual publication. So looking at employer social contributions versus wages and salaries at a sectoral level. So within this table, you can kind of look at and compare sectors that have a high percentage of wages and salaries versus lower sectors. So for example, construction there, COE, so the labour costs are primarily wages, and there's only about 15% there attributed to social contributions, whereas a sector like public admin and health, there's nearly 20% of the labour costs from the employer's perspective are social contributions. In the annual publication, we provide this breakdown at an even more granular 64 sector breakdown. So in this table, we have the kind of the money values. So total COE, the wages and the social contributions, and then the relative percentage contributions to total COE as well. So there's a lot of detail there. And again, it's just highlighting that table exists and that breakdown is there in the annual publication. Next, I'm going to talk about COE at constant prices. What we mean here really is constant compensation. So the goal here is to try and remove the effect of wage inflation and to look at COE in terms of in volume terms. So we were asked about this before, how exactly we do it. So we calculate the value of COE using COE per hour from the previous year. So basically wages per hour, and we use that and we hold constant that compensation, so wages per hour. And then in the same way we do the other constant prices in other parts of the accounts. We chain link the series with the base year of 2022 this year. And so we get our estimate of constant COE. And so the remaining growth there is in theory based on a change in the volume of labour input, because we've held constant the compensation, the wages per hour. So in this chart here, so this is looking at annual COE and comparing the current versus constant. So in green there, you'll see just current price COE, where we've made no adjustments. This is primarily coming from the PAYE modernization file. So that's the admin tax records from revenue. When we apply this method of holding constant the compensation, you can see in blue there the trajectory of COE is just slightly flatter, I guess, in particular in 2023. We provide this constant price data in both the quarterly and annual publication in the wages chapter. So you can kind of compare constant and current price COE at I believe it's a 21 sector breakdown. So yeah, again, just highlighting that breakdown of COE is in the publication. And finally, we're going to look at the income distribution. So again, this is a new thing, and it's just trying to lean into that kind of rich data source that we have for COE, so that the payslip level data from revenue. So here on the x-axis, we've broken COE down into income brackets, and on the y-axis we have the percentage contribution to total COE within each of those income brackets. So looking at this at a glance, we can obviously look at the shape of the distribution, and clearly there the bulk of COE, so around a third of COE is coming from those in the kind of between 30 and 60,000. When we add in the 2022 distribution as well, side by side, we can kind of get a glimpse into the growth in COE. So we know COE has grown in 2023, but this just allows us to see kind of a little bit more insight into that. So it kind of tells us that wages are obviously growing up, but if we look at the lower income brackets there in 2023, they have a kind of a smaller percentage contribution to total COE. And as you moved up the income brackets, 2023 there, have a higher percentage contribution to total COE. So it tells us that wages are increasing, but it can also be the case that individuals are kind of shifting from lower income brackets to higher income brackets. So it's just that ability to kind of look into a bit more detail into the COE data, which is present here in this table. I believe that, yeah, that's all I have for today. So those three items there, again, just highlighting that they're in the chapters, and because COE is such an important domestic indicator now, it just goes into a bit more detail. So thanks everyone, and I'll be happy to take any questions.
Thanks, Conor. So I guess that really is a sample of there's an awful lot of COE development over the last couple of years, and it's a sample of three items, and there's plenty more in there. But let's have a check and see if there's any questions on that one. Nothing in the chat yet. John, do you want to lead us off again?
If nobody else will, Very interesting. That's effectively a L'Espère index, is it? It's base weighted, where if you divide employment in the sector into the wage bill, you're getting something closer to a Fisher ideal index. And there's another way of what you're talking about here is deflating the wage bill. But if you use the deflator for the sector, and this becomes important in the multinational sector, the value added in the multinational sector is the wage bill and corporation tax. So the volume change contributing to the volume change in national income is the wage bill deflated by the deflator for the sector rather than by the wage rate. They're two different concepts, but that one, in terms of contributing to the growth in national income, is, I think, the one to use. I have two other questions. One on the consumption of fixed capital. It's deflated differently than the net output in the sector. Is the deflator for the consumption of fixed capital, is that the investment deflator for the sector? And the final question was on the corporation tax. No, I've forgotten what my question is there, but you
can come back. I don't know if you want that one, do you, or do you want to?
Which
on deflator on?
Well, I suppose it's the same method that we use in the other parts of the accounts. It's about all I'll say there.
It's using the.
Do you want to give the mic?
Sorry.
Yeah, right in front of you.
Oh yeah.
It's like it's similar to the way we chain link all the other variables. So it's using the latest weights from the previous year. So it's the pair of years. So in that respect, it's a L'Espère index, but it's chain linked, you know. So, yeah. So
I think it is also worth saying that we have three different methods and three different types of deflators for them. So you're right, the CFC is the asset deflator. On the output method, we have sector level deflators. Now the income method is different because lots of countries don't do an income method. So a lot of them would be considered experimental or developmental. So we've taken this to a medium to good method internationally for COE. We don't deflate profits. How would you deflate profits? That's another kind of conceptual one to look at. But yeah, in practice, we follow three different types of deflators for the three different methods, which could give you different results.
It'll give you different results, not consistent with your national income results. But it's still, nonetheless, it's extremely useful because it's telling you what is happening to wage rates across the economy. So I'm not knocking it, but it is just that how one uses it, you need to take account of the differences.
Yeah. So I'm not sure. I had to log in again on Teams during it. I think I can see the chat clearly that I don't think there's any questions there on wages. Oh, there's one more in the room. We might just go to Chris.
For the shares of the wage bill that go to employer social security contributions for the different NACE categories, what are the different drivers of that? Like you'd assume it's increasing in the average wage in the sector maybe, but there's other things, I suppose, like the amount of sick days that people take.
So are you saying, so in some sectors the employer social contributions is higher than others? Yeah, well, I suppose, employers' PRSI would be consistent, but other parts of social contributions would vary across sectors. So I suppose that would be the main difference, yeah.
The pension contributions in the financial sector and the public sector are probably...
Yeah, exactly, yeah. So
in construction, there's none, or...
Yeah,
something.
So the employer's PRSI is the constant one, but all of the other parts of social contributions can vary, yeah.
John?
I have remembered what my question was on corporation tax. And what I'm interested in is getting at what's happening to net national income on a quarterly basis. And in the you have GVA for the domestic sector, for the foreign sector, for the multinational sector. We now have the wage bill. The corporation tax receipts are the other part of that. Now, are the corporation tax, is the Revenue Commissioner's information on the corporation tax collected in a particular quarter. Do you treat that as part of the quarter for the national accounts, or is there a different alignment between the Revenue Commissioner's quarterly data and your data?
So which angle will we approach this? Do you want me to start off with this and you can...
Sure, yeah.
So I guess we don't have an income method quarterly, right? So, and tax is after GDP, right? So, but where it does feature is it comes out of, say, M&E profits before they go into the net factor flow. So it does come in there for GNP and GNI and NNI. So we collect that on an accrued basis. So M&Es report to us their tax accrued in the quarter so that their production and their tax and their profits are all lined up. And we have done some research on that to look after the year is out and all the cash payments are made to revenue, that what was reported to us on an accrued basis for the very biggest companies is what they actually paid. So we're pretty happy with that, and we should probably do a little bit more on corporation tax. That was anything else?
Well, just yeah, like you said, we don't use the corporation tax data in the Q&A, but for the annual, we get our cut of the corporation tax data around October, November, and within that we kind of get our estimate of the activity for. So for this year we had 2022 tax data, so that's their activity in 2022. And then we kind of have to perform some kind of calendarization to kind of get a January to December estimate of the activity. And that's how we get our kind of profits in the annual accounts for 22 and 23. Yeah.
I'm just going to check the chat. There's a few things come in there. I think Thomas wants to ask a question. So if we could unmute Thomas Conor, we can bring him in first and I'll check the other questions just while.
Thanks. I think I'm unmuted. On the compensation data by foreign and domestic, and apologies if this is here already, but could we get the number of employees as well, foreign and domestic, because that would allow us to calculate a compensation per employee for foreign and domestic. That's one. And then the second one is just a quick comment on go back to the earlier one on the investment by sector, stripping out the R&D. Even just for the two sectors where the R&D is concentrated, I think you said it's in manufacturing and in admin, if there could be for those two, and of which R&D, and even that would be great, because I think the R&D component of all the other sectors is tiny. Thanks.
You want to go first?
Yeah, we could add in the number of persons by foreign domestic, because that data too would be in the same data we get for compensation of employees. It's just that it would differ to the employment estimates that are already published in the CSO from our colleagues down in Cork. But we could certainly give estimates of employment by foreign versus domestic to accompany the COE by foreign domestic as well. Yeah.
It's important to say it's on the research agenda for sure, I guess, but it would make it a lot easier if all our sources gave us the same answer, and then you could use breakdowns from one and another. And when they're slightly out, we have to, try and tie it up. What's the difference? Why do we have a difference in administrative data and survey data? And try and, isolate the factors behind it. We thought the census update might help with that, but there's still more work to do. So even after census is published in all the publications come out the last couple of months, we still have more work to do on that. But taking the richness of the data you're using and showing, average wages for M&E, that's something definitely we should do with it. Even if it doesn't align, we should still show it to you. There was a question
on investment. Yeah. So no, absolutely. That's one way of approaching it. Just stripping out the R&D from the R&D heavy sectors. I mean, I suppose similar to what I said to John earlier, like with a lot of this stuff, it's going to be trial and error. Try a couple of different permutations, see how confidentiality is affected, see what we can actually release. But no, definitely it's a good suggestion. And just to say, I suppose a note, it's really useful to get this kind of feedback from users, from I suppose what they'd find helpful in the tables, what they're finding helpful at the moment. So I do appreciate the contributions and the suggestions for this.
One more question. Thanks, Thomas. One more question from Killian Carroll for you. He asked about, and it's a timely one, about the revision upward to COE in 2023. What's the revision? So you have a...
Yeah, I suppose it's just down to our kind of improved understanding of our data sources. So within the income approach, we use obviously the CT data for profits, and so that's from revenue. We use the PMOD, PAYE modernization from revenue as well. We use the Form 11 file from revenue, so that's the self-assessed tax returns for the self-employed income. So the upward adjustment to COE is just kind of our better understanding of what to include and what not to include within those data sources. In particular as well, when you start to merge those data sources, you kind of uncover things that you should include and you shouldn't. So that kind of explains the upward revision. It's just our better utilization of that data. Yeah.
That was a good opportunity to explain that one, because it's one of our bigger revisions, I guess, with the benchmark. So just one last comment came in from I don't know who SB is, but you're saying that the M&E, non-M&E employment split would be really useful. So I think we'll definitely, that's on our research agenda. We'll have a look at that now that the census data has gone through. We're heading close to 1 o'clock. We did promise to end at 1 o'clock. So unless there's any other questions, I'll thank all three of the speakers here and the panel from earlier. And I hope you enjoyed the extra material that's come out mid-year around the annual results. And we'll see you all in September for the next quarterly press conference. Thank you very much.